So let me show you an example of the weighted average cost of capital. So suppose a company has a total enterprise value of $20 million. And we'll go through what enterprise value means in just a second. But basically that's the value of the firm. And they have $7 million of debt. And they have cash of $2 million. The debt has an interest rate of 5%. And the company's tax rate is 25%. And let's just say that we know that the cost of equity at the firm is 10%. So in order to calculate the weighted average cost of capital, we're going to use this formula. And we are going to say 10% is the cost of equity right here. The cost of equity is 10% times $15 over 20. Now you might be wondering, well, where did you get that $15 from? Well, the enterprise value, the calculation for the enterprise value is the market value of the equity plus the market value of the debt minus the cash. And why we exclude cash is because if I were to buy a company tomorrow, and let's say the company had $1 million of cash on the balance sheet, and let's say I paid $5 million for that company. Well, I pay $5 million for that company, but when I buy the company, immediately I get $1 million of their cash. So that's why we exclude cash. So even though I paid $5 million for the company, in reality, I only paid $4 million because I buy the company for $5 million, but then I get the company and immediately I get $1 million in cash from that company. So the enterprise value is just taking the market value of the equity plus the debt minus the cash. So to get to this $15 million right here, I just backed into that $15 million. I took the $20 million minus the $7 million plus the $2 million to get to $15 million right here. Next, after we calculated the part of the equity, we add in the cost of the debt, which is the interest rate of 5% right here, times the amount of debt at the company, which is $5 million, the net debt. And how we got net debt was taking the $7 million in debt minus the $2 million in cash, divided by the $20 million, which is the enterprise value. Next, we multiply it by 1 minus the tax rate, and the tax rate is 25%. And after we take all of that and add it to this right here, we get 8.44%. So that is the weighted average cost of capital at this firm. Or in other words, that is the discount rate at this company. So that's an example of how we'd calculate the weighted average cost of capital. Now to calculate the WACC, a lot of these values are actually pretty easy to calculate. It's pretty easy to derive the enterprise value. It's super easy to figure out how much debt the company has and how much cash the company has. It's really easy to calculate this interest rate right here and to figure out the tax rate. But the bear is to figure out the cost of equity. And in the CapEx formula, the cost of equity, this is the huge headache that we have. Now, in order to calculate the cost of equity, we need to use what's called the capital asset pricing model, the CAPM model. Now, the CAPM model is a little bit intense, and there's a lot of different moving parts to it.
We will come back with a video on how to do the CAPM calculation here shortly, so check back or click the link. Be sure to like or subscribe and leave any questions you have in the comments. Thanks.